Good day and welcome back to these Future of Finance discussions on digital innovation. I'm Bob Currie, contributing editor at Future of Finance, and my guest today is Ciarán McGonagle, Chief Legal and Product Officer at Tokenovate. Hi Ciarán, how are you?
Hi Bob, very well, thank you. How are you?
Very well indeed. A belated St. Patrick's Day good wishes to you, by the way.
Yeah, thank you. Well, I'm doing the side proud with the green walls.
Perfect. That's what we like. We like a bit of colour at Future of Finance.
Mhm.
Tokenovate specializes in delivering post-trade automation for derivatives and securities finance transactions. And when expressed in that way, captured in a single sentence, it sounds like quite an easy job. But we all know, those of us that have been working in sort of post-trade and automation for some time, that this broad description embraces a wide range of operational, legal, and technology-based challenges that extend from pre-trade right down across the trade life cycle. It involves many moving parts and demands digital standardization across multiple areas to enable automation of workflow, which I think is part of the task that Tokenovate is set up to deliver. But let's just unpack those themes a bit more, Ciarán, just to get the ball moving, if that's okay. Let's look a little bit more closely at these objectives and the key challenges and problems that Tokenovate was established to solve.
Yeah, thanks, Bob. So I think when I talk about Tokenovate, I think it's always useful to go back to first principles. So what is the problem statement? What are we really trying to solve for? And you mentioned post-trade. I think as an abstract thing, it sounds quite straightforward, but actually, as you mentioned, there's a lot of different moving parts. So we think about what post-trade really is, and I think this goes really to the heart of the problem statement that we have. If we look at derivatives contracts, SFTs, they are very complex products. They all have very different features, payout features, etc. But they all have some common features. I think principally the fact that they are all long dated transactions. So what I mean by that is that a derivative or an SFT, by definition, is a product that involves some future cash flow or the future delivery of an asset. And so there's a period of time after the trade has been executed, been entered into, where the risk associated with maintaining that position over that time period has to be maintained and managed. And when we think about post-trade, it's really the infrastructure that has been developed over the last 20, 30 years and longer to manage and maintain the risk associated with those positions. And I mention that background because I think when we look at the post-trade environment, particularly over the last 15 years, that post-trade infrastructure has become much more complex, I think primarily as a result of the regulatory reforms that we've seen since the financial crisis, since the G20 mandates of 2009, which have required entities entering into those sorts of transactions to report positions relating to those trades, to post margin where they perhaps didn't have to post margin before, and to do an awful lot more things related to the credit, the market, and the operational risk management of those trades. And so we look at the post-trade environment now as not a kind of a single process, but actually as a combination of interrelated processes, each of which have their own complexities, each of which have very likely been built in silos across different institutions and across the industry more broadly. And so where we are now is this kind of siloed patchwork environment where we have multiple different systems, each recording data in multiple different formats, recording and processing lots of different processes relating to those trades and different products. So it's a really complex infrastructure we have, and we would argue unnecessarily so. And so really what we're trying to do at Tokenovate is to really simplify and make that process much more efficient using the new technology solutions that we have at our disposal. And so when we think about the post-trade lifecycle as being all of these various different touch points, these various different systems, and we'll come on to talk about specifics as to how we do this, we think that you can use new technology solutions like DLT, like blockchain, like tokenization, like AI to create much greater efficiencies across the trade lifecycle. And that's really important. I think when we talk about operational efficiencies, sometimes you see people's eyes glazing over a little bit. It's something that you read about a lot and is a very kind of abstract and at times meaningless thing to say. But actually, it's really, really important, because if you think about the role that derivatives, the role that SFTs play in the global economy, the role that capital markets play in the global economy, the capital markets are the means by which private enterprise within society raises money, and it's the means by which societies generate growth. Derivatives are the means by which private enterprise hedges risk associated with the growth of their companies and the development of products and innovations. Capital markets are the means by which macroeconomic policy is transmitted into society. So as we, as a society, look across the kind of the economic picture that we have these days, and it's quite grim reading. But if we think about ways in which we can grow economies, the ways in which we can invest sustainably in economies, whether that's innovation across new technological innovations like AI, like blockchain, whether it's sustainable investment and development, the capital markets are going to be really central to all of that. And if there's a means by which we can reduce the operational cost base that these organizations are straining under, that inevitably frees up much more capital that can be invested in the real economy and can generate growth for all of us. So although it's not the most sort of interesting discussion to have at dinner parties, we work in post-trade capital markets efficiency. I think it's important for everyone to realize that it does have real tangible effects on all of us.
I think that's all really a feature of just having the right sort of dinner parties, Ciarán. But
Perhaps, yeah.
Tokenovate has argued that incremental change is no longer sufficient. It's a high-level statement that's sitting there on the website. Tokenovate indicates that this requires transformational change to deliver a financial ecosystem that is automated, resilient, and efficient. Why is incremental change no longer sufficient? Why is this radical departure required at this point in time?
Yeah, so I think what we've seen over the past 10 or 15 years has been incremental change. So this kind of, I think, tactical response to emerging regulatory requirements and market changes. And to some extent, that was inevitable. I think the sheer volume of regulatory requirements that banks had to deal with and address in the post-2009 period meant that it was actually really difficult to take a step back and think about what the future of trade processing might look like in a holistic way. I spent a bit of time working in a couple of different banks, so really being at the coalface of this. So I saw firsthand how, when you're dealing with, for example, a new regulatory reporting mandate, how labor intensive, how cost intensive it was to introduce those new requirements within the operating model of the institution. And so what we've seen as a result, as I sort of alluded to in my opening remarks, is this very, very, I would characterize as tactical solutions, tactical builds to address these very immediate challenges. But I think we're at a point now where we can start to think as an industry a little bit more strategically. The pace of regulatory change has slowed down. Banks are operating under increasing cost pressures. And I think we are now, as mentioned before, have some of the technologies, and I think a sufficient maturity within those technologies that allow us as industry participants to think about this problem much more holistically. So we feel that not necessarily a radical departure, but actually sort of a much more, I'd say, strategic approach to addressing some of these issues. So how do we think about the future of capital markets in a world where we have the ability to record trades on decentralized ledgers, where we have the ability to use technology to affect cross-border settlements on a T+0 or on an atomic basis? How do we think about capital markets in a world of AI? I think it's important now, and it's incumbent upon all market participants to think about how do we want to work in the coming 10, 15, 20 years. I think that's the inflection point, and that's the moment we're at.
Thank you. We're going to talk a bit more about digital standardization and how you bring your own expertise to shape that dialogue. But before we do that, can we just also talk a little bit about the origins of Tokenovate and how the company maybe is built on the expertise and past experience of its two founders, Richard Baker and Gerard Benakovitz?
Yeah, so Richard and Gerard started Tokenovate a few years ago. I first met them at the ISDA AGM in Madrid, which I think was 2022, where they had just really started out on the journey. And one of the things that struck me really about Richard and Gerard when I met them and got to know them was, I think, not only the depth of their expertise in the technology in the industry, but actually really the breadth of their experience. So across multiple different sectors in telecommunications and procurement, and actually across the organization, we have people with really various backgrounds in healthcare and IoT and maths and all sorts of different domains. And that's, I think, it was quite a powerful proposition that they were, I thought, bringing to the market. And I say that because there's a tendency in financial services, certainly, but perhaps across every industry, to think of itself as somehow exceptional. The problems that we're dealing with have never been addressed anywhere before. But if you look at an area like telecommunications, for example, and my old boss at ISDA, Scott O'Malley, was very fond of saying this. He'd say that, the telecommunications industry moved from 2G to 5G in just over a decade, whereas the financial system is, still operating on 2G. I think there's a lot of truth to that. When I started in 2008, I'm not sure that I even had an iPhone at that point, and now I have an iPhone with 5G, and the financial market still operates roughly on the same technology and payment and settlement rails. And so I look at people like Richard and Gerard who have had experience in driving this kind of transformative change across other industries. And yeah, I don't think the financial services industry is exceptional by any means. And in fact, there are probably a lot more different challenges within telecommunications than there are in financial services. And they were able to see that journey through. And it was that kind of different perspective and the experience and expertise in realizing, I think, some of the opportunities that we have in financial services in different markets that I personally find really compelling about the business.
Thank you, Ciarán. I mean, maybe one thing that telecoms has brought to the show is their ability to sort of build innovation around standardization, if you like. Without standardization, telecoms doesn't really work very well. And I suppose that metaphor does hold in our industry, to a degree as well. I mean, in your previous roles, and you've alluded to your role at ISTA as Assistant General Counsel for Smart Contracts and Digital Assets, you were quite heavily focused on the need to encourage consistency of trade representation and to promote common standards to support automation across the life cycle of the trade. How does your previous experience inform your current work at Tokenovate?
Yeah, it's really central to it. So I spent just under 7 years at ISDA, working across a number of different initiatives, both in the legal and documentation space, but also in the regulatory and policy environment, and across a lot of different issues, from LIBOR transition to the redevelopment of the interest rate derivatives documentation framework, to the development over a period of years of, I think, some fairly foundational work on the legal treatment of some of these new technologies like distributed ledger, as well as work to really unpack how some of these new technologies could be embedded within some of the existing products and the standards initiatives that ISDA has led so well over the past 40 years. And I think when you have an experience like that, working at that level of industry and benefiting from the expertise of ISDA's members who have really been embedded in this world for a number of years, you do begin to get a different perspective. And I think there's a lot we can learn from ISDA's journey over the past 40 years, how ISDA was founded, the problem statement that it was trying to solve at the time, and some of the solutions. If we look back, for example, to the ISDA Master Agreement over the past 20 or 30 years, I mean, that has probably been one of the most successful product, or perhaps you could even call it a technology initiative, that has been embarked upon by the industry. If you think about the growth that we have seen in the industry since the development of the Master Agreement, how that has kind of promulgated across the market. It's now probably the most widely used contract in the capital markets, and it has created an enormous amount of efficiency and netting and capital benefits and all of those good things. And you think about how that was developed and the problem it was trying to solve, and I do feel that we're at a somewhat similar moment currently, where we think about perhaps looking at how the standards issues around documentation have been solved, perhaps applying some of those same principles to the operational and data standards that have been developed over the past 10 or 15 years to implement those contractual standards across the industry. Again, we get into post-trade and we think about, well, a post-trade process is simply an operational implementation of some contractual obligation that sits in a document. And so how do we think about connecting all of those things together and ensure that when contractual obligations and contractual rights relating to trades and relating to post-trade management of those exposures are implemented within a system, how do we ensure that as an industry we're doing that in the same way? We're using the same language, we're using the same standards, such that as we start to build out the post-trade infrastructure of the future, we're not doing what we did over the past 15 years, which was to build things in silos, using different data formats. We can use different systems, but if we're all using the same data format, something like is the common domain model, it solves that interoperability issue. And it means that vendors such as Tokenovate and other providers in the market, we can compete on innovation rather than creating these closed systems where you can't really do anything unless you're within that single system, because it can't speak to anything else.
Yeah, we'll move on and talk a little bit more about common domain model and some of those useful themes shortly. But could I just ask you, Ciarán, now in more general terms about some of the sort of practical projects or the use cases, if we use the jargon, which are the key use cases that Tokenovate has chosen to target, and why has it selected those?
Yeah, so we think again about the issue really strategically and holistically. So we are, as mentioned, very embedded within the standard setting body. So not just ISLA, but also ISLA and ICMA. And we do that because we want to build a post-trade lifecycle engine that remains consistent to and with the standards that have been developed by those trade bodies over the past 20 or 30 years. Again, these aren't abstract things. This is the collective knowledge, expertise, and market practice that have been developed by the thousands of members across all of those organizations. And so it would be, I think, naive and foolish of us to think that we can build something distinct and separate from that. I think we want to tap into that wealth of knowledge that already exists. And so as we build out our automated engine, we do so, as mentioned, based on the legal standards, the operational and data standards, which I'm sure we'll come on to. But as a kind of a strategic play, you obviously need to make that real for people. And so we think about, as we go to market, as we start to speak to potential customers, how do we make that real to them? So what are the pain points that they're experiencing at the moment, and what are the use cases through which we can really demonstrate the best use of the technology that we have at our disposal? And so one of the use cases that we're looking at the moment is intraday repo. An intraday repo is an interesting case study because I think when we speak to the market, we hear that certainly as applies to things like DLT and tokenization, repo is a really compelling use case. And particularly so intraday repo, because I think what the technology gives you above and beyond what exists today is the ability to enter into intraday transfers, intraday lending arrangements. And we do that by allowing for atomic settlements, or providing for atomic settlement within our system. So providing for intraday exchanges of tokenized assets, tokenized cash. Those are things which DLT technology and tokenization can provide. And so that's a really interesting use case to explore, I think, as an initial use case, as an initial POC. Another area that we're really looking at is money market funds, so the tokenization of money market funds. And there's been a lot of discussion among various different industry groups around how tokenization can really free up and increase the liquidity and the utility of money market funds, particularly in the context of collateral for derivatives or for securities lending. And so we have been developing a technology solution that would allow for the operational tokenization of money market funds and their use as collateral within derivatives trades. We recently ran an event which we call a Living Lab event a couple of weeks ago, where we invited some of the top asset managers in the UK and a couple of different banks to come in and interact directly with our technology to tokenize money market funds, to use them as collateral for interest rate swaps. And the feedback was very positive. I think what it really demonstrated for me was that people are really much more keen now to move beyond the theory and move into practice, to see how these things actually operate in practice. And so we think that through demonstrating some of the use cases that I mentioned, exposing the market to them, allowing them to interact with them, they will see immediately sort of the near-term utility of automating some of these processes, of tokenizing some of these assets. And that will allow them to, I suppose, understand the longer term and the bigger vision that we have of creating a completely automated, streamlined and standardized post-trade lifecycle system.
Just on that note, and very briefly, I mean, are there specific examples, practical projects and use cases where the market's been really biting, where there really has been strong demand and appetite from the market, for take up and requests for you guys to move that forward, particularly quickly? Have some been getting more bite than others?
Yeah, I mean, I do think it's in the repo space, and I think that's a function of the trades themselves being relatively straightforward to process. And also, I think the benefits of tokenization and DLT, as I mentioned, are really tangible. So I think we can move at pace to provide that kind of functionality to the market. And I think, bigger picture, what we really want to demonstrate is that there's sufficient commonality across all of these products, such that once you begin with repo, you can very quickly extend that to other products that have similar and common features. But I would say it's that repo use case which seems to kind of come up in every conversation that we have.
Moving things more intraday, more towards atomic settlements. There seems to be a
Yeah, I think
strong
that's
appetite.
exactly the opportunity that people are going after.
That's excellent. Thank you. Following that point, really, I mean, financial projects, if we simplify them, they're essentially bundles of rights and obligations. I think, as you alluded in your introduction, sort of bundles of rights and obligation governed by conditional logic that will guide, future cash flows, or it will guide transfer of legal ownership and other life cycle events. Moving this more specifically into our digital dialogue, what are the challenges, Ciarán, in capturing those rights and obligations digitally in a smart contract and using this to deliver event-driven automation?
Yeah, no, I think that's exactly right. So perhaps this is me with my lawyer's hat on, but I've always viewed these products as you mentioned, bundles of contractual rights, events, obligations, etc. And so while it is that I did really a lot of work on that question, so how do we create a system that is capable of automating the obligations and rights within a contract, whilst also responding to events which may modify the operation of those obligations and rights, or may even prevent them coming into existence at all. So we think about, for example, a derivative trade as being something which actually lends itself really well to this kind of smart contract logic, because derivatives are essentially um, conditional logic based trades, in the sense that, if you and I enter into an interest rate trade, what that will typically imply is that I will make some payment or delivery to you at a point in time if some condition is satisfied. And so that, very easy, I'm not a computer programmer, but even I could probably have a go at coding that. Where the complexity really comes in is, as we sort of alluded to, is around the events. And so I can certainly very easily code that kind of operational logic within a smart contract. But what happens if, for example, in the period between which we've entered into that contract and the date on which that obligation arises, there is an event, such as an event of default, or you or I become bankrupt, or it becomes illegal for me to make that payment, perhaps because you're based in a country that is now subject to a new sanctions regime. And so there's an awful lot of work that we need to do as an industry to understand, what are those parts of a contract that you can easily automate, and what are the various different off-ramps that we need to think about in order to reflect the occurrence of events. And yeah, I could talk about this for a long time, but I think, simply put, I think there is a kind of a two-step process that we go through, which is to understand, first of all, whether we can automate a particular provision within a contract effectively. So is it capable of being represented as a smart contract or as conditional logic? And here we distinguish between things like a payment obligation or a calculation or evaluation, which is heavily conditional, and then a provision which is much more open to human discretion. So, for example, an obligation or a right to do something in a reasonable manner or in a commercially reasonable manner, things like that. And my thesis would be that the former category is much more susceptible to effective automation. And then we come across the question of efficiency. So whether or not something is effective or can be effectively automated, we also have to ask ourselves whether it would be efficient to do so. So in that example, that interest rate calculation and payment example, it's clear that that would be very efficient to automate because it would probably obviate the need for multiple different systems within that process to perform the calculations, evaluations, the bank transfers, etc. But if we think about potentially other provisions within contracts, which are much more complex and which have lots of different touch points in external systems and elsewhere, there is a much tougher question we have to ask ourselves. What is the immediate efficiency gain that we can gain from automating that process? And so that's a question that we're constantly asking ourselves at Tokenovate. Where is the low-hanging fruit? So is it intraday repo, which are relatively simple trades, which can be executed in a fairly autonomous, automated manner, versus something like a very, very complex structured product, which has lots of different calculations and permutations, which, while possible to automate, might not be efficient to do so. And so those are the sorts of questions that we kind of ask ourselves, and it's really informed by much of the work that I did at ISDA, where we published a number of different studies across different product types and asset classes around how we automate these things, both in theory and in practice. That's proven, I think, really, really valuable, proven really valuable in my new role at Tokenovate, where, this is essentially the question we're asking ourselves every day.
Thank you. I'm just going to come back to that very shortly, just in terms of sort of the enforceability of those sort of smart contract embedded provisions, in real world law, if you like. But before I do so, I just want to come back to the point that we introduced earlier, and that, is how you're using common domain model to assist your process. Many of our viewers will be familiar with CDM. There will be maybe one or two that won't. So just in a nutshell, to give us a sort of a nutshell in terms of what CDM is, but more particularly just how Tokenovate is using that to assist your process.
Yeah, so Common Domain Model was an initiative which began at ISDA in 2016, 2017. And if you kind of go back and look at the white paper, it's really in the white paper that accompanied development of CDM. It's really quite interesting to see what the kind of the vision statement was at the time. The vision really was, I think, actually addressing the problem statement that we started with at the outset. So the fact that the financial system and the derivatives market is very siloed, the systems aren't interoperable, there's lots of different data, formats and standards out there. And so the CDM was really an attempt to address that problem. So to create a standard, an industry standard way of representing different events and different products and product features across the market. So you might consider it as a kind of a standard data blueprint of different types of derivatives products. One of the benefits or one of the core features of CDM is that it is product agnostic. And what that means is that it's not creating a separate modeling language or a separate domain for different products, I think, in the way that perhaps current systems work. So there isn't an FX common domain model or an equities common domain model. There's a domain model for financial products more broadly. And that has, I think, really significant benefits for what we're doing. So something I alluded to earlier was that as we build out our post-trade system, we want to do that in a relatively product agnostic way. And the way that we think about it is that these products all have very common features. I think if you distill them down, as mentioned at the outset, a derivative and an SFT, whether it's a repo or a securities lending trade, will all have common features in that they all require or result in, or may result in, the exchange of cash or assets at defined points in the future based on the satisfaction of certain obligations, which is based on conditional logic, as we've discussed, set out in the underlying contracts. And by abstracting away all of the kind of product specific terminology and some of the, I think, the conventions that have been developed across these markets over the past 10, 15, 20 years and longer, CDM provides a really powerful basis and a really powerful foundation for which to drive a genuinely product and asset agnostic system like ours. And so we look at CDM as really a core foundational layer of our system. It's embedded in everything that we do across our tech stack. But CDM is, as a domain language, as a domain model, it provides you with the kind of the Lego blocks, as I would say, the Lego blocks. It gives you all of the various different component parts, allowing you to build products and to build the product lifecycle relating to those products. What we as an industry need to start building out is really the instruction booklet for how to put all of those Lego blocks together in the right order and in the right combination to build the products and to run the life cycle in a way that's consistent with the underlying definitions. And so the work that we're undertaking at Tokenovate is to do what we call operationalising the CDM. So it's essentially creating those instruction booklets based on the underlying product definitions, which will allow us to set out and to provide back to the industry a way of thinking about, well, given a certain data set, we can characterize or we can qualify that as a specific product which follows a specific life cycle based on the specific legal documentation associated with that product. So we can do all of that systematically within our engine. And then we can run the life cycle in accordance with that underlying contractual logic. So for a repo, we know that once we get the trade confirmation and we ingest it and create a CDM-based object, that we will have an execution, we will have a contract formation where we associate the trade with the GIMRA, with the confirmation. We will have a transfer, an atomic transfer of cash against securities. We will have another transfer, an atomic swap of the securities against the repurchase price, and then we will have a maturity. And those are the core building blocks that we build up based on the underlying terms of that trade. And we can reuse those building blocks across an FX forward, for example, which, when you abstract away the kind of the FX specific conventions and things like that, operates in much the same way. It's an execution, it's a contract formation, it's a transfer, and it's a maturity. And so that's how we think about it. And CDM gives us the ability to think about things in that way and provide us with the foundation to build all of this additional logic to automate the life cycle in a way that's consistent with the legal framework underpinning it.
Super. And a lot of that CDM is sitting in open source now in the Finos repository. I think you're quite involved with some of the Finos working groups, but that's accessible to companies that want to access that through that open source route. Is that correct?
That's absolutely right. Yeah. So it's open source. So really, anybody can get involved with this. And actually, if I can perhaps make a little bit of a pitch for one of the Finos working groups that's just been spun up. So we started a dedicated Finos CDM working group looking specifically at issues relating to tokenization. We had our first working group last week where we had a really good number of attendees. I was chairing the group, and I will be chair of the group. And I think through that group, we're going to be looking at opportunities to expand the CDM to allow for tokenized settlement and the representation of tokenized assets within CDM. And it was really heartening to see actually the level of engagement across the industry with that. So we had representatives from standard setting bodies, from banks, from law firms. And I think, to me, that demonstrates a few things. I think one is that, this is a multidisciplinary area. When we look at tokenization specifically, it's both a technological but also a legal domain specialism. And so having expertise from across the market, across those different areas, is going to be really, really important as we build out the foundational architecture that's going to allow tokenization to be embedded within some of these markets. And I think more broadly, if we think about CDM and expanding CDM across different use cases, so I see no reason as to why, as we move into a world of tokenized assets where we need to think about how do we synchronize records across different DLTs, how do we deal with that interoperability issue, how do we think about the issuance of new digital securities, there's really no reason why CDM couldn't act as the foundational layer for representation of all of that. And, to me, again, thinking with my Tokenovate hat on, doing so would provide an incredibly powerful proposition to the market, I think. So you think about a world where we have assets in tokenized form represented in CDM, which is able to then benefit from some of the features and functionality of CDM. For example, thinking about tokenized assets where you're able to programmatically apply collateral eligibility assessments to those assets natively, where you're able to embed those assets directly within the post-trade lifecycle obligations and events that comply within collateral management, for example, and have all of that automated with CDM as the operational base layer. It's really, really powerful if you think about it expansively. And so that's I think how we envisage it. And as we go further along this journey, we do see, everywhere we turn, I think there's opportunities for us to really build upon CDM and to deliver all of these efficiencies to the market.
Thank you. As a non-lawyer, I mean, one thing I feel fascinated by is how well traditional legal precedent can be applied to the sort of new law and the new electronic contractual provisions that you're embedding in smart contract frameworks.
Yeah.
In our previous conversations, you've highlighted the need to recognize limitations, perhaps, of traditional legal frameworks when applying those to the properties of digital assets. Could you just sort of unpack that a bit? And maybe whilst you do so, can we touch on the Law Commission's guidance, which is interesting? I mean, they warn against relying on rigid, outdated legal precedent, instead urging courts to evaluate each digital asset according to its specific technological characteristics or features.
Yeah, no, absolutely. This is a really interesting topic. And I think I would begin by saying the Law Commission have done really fantastic work. Some of the work and the papers that they've put out over the past few years have been really, foundational, I think, and really influential in advancing greater understanding of the legal and property characterization and treatment of different types of digital assets. But I think as I start to work with this technology a little bit more and really, operating at the coalface of these technologies, I think a number of different issues and questions stand out for me. I think the first thing to say is that there's no doubt in my mind, and I think really there's very little doubt across the industry, that digital assets and tokenized assets are capable of attracting property rights. I think that's pretty well established now via the Law Commission's work and various case law over the past few years that have confirmed that. I think that there's a question for me, though, around the implications of that. And so I think about, for example, it's all well and good saying that a digital asset or a digital object, as the Law Commission refers to it as, is capable of attracting property rights. But what does that actually mean in practice? So if I can put it another way, what use is a property right if there's no means by which you can enforce it? And the reason I say that is because I think if we look at some of the recent case law, and I think there was a case, Deloya, which I think really highlighted this, and we look at some of the issues that we've seen in the recent weeks with the Bybit hack and the North Koreans infiltrating those systems to steal large quantities of digital assets. There's a really sort of interesting question in my mind around how do we look at the operational protocols of some of these blockchains and ledgers, and how do we think about the enforcement of property rights and claims in respect of those assets? And some of the, I suppose, the interesting work that I've been involved in has been around the distinction between different types of protocols in the blockchain space. So I think this is a massive oversimplification, perhaps, but we think about blockchains as really coming in two different flavors. So one of those is a UTXO, or unspent transaction output blockchains, which are operate in much the same way as Bitcoin, which I think everybody's familiar with, versus account-based blockchains, which kind of roll up transactions and asset transfers in sort of account omnibus-based account type systems, which again, people in traditional finance will be familiar with. And that's to be distinguished with UTXOs, which I think retain a chain of provenance. So if I think about an unspent transaction output as being an initial coin that I spend, and then that coin being perhaps fractionalized and reaggregated over time, and spent and spent and respent down the chain, it's always possible to trace the provenance of that coin or parts of that coin back to the original Coinbase output. And that raises interesting questions for me as we apply the thinking around this technology to some of the legal principles that have been applied to things like, how do I trace digital assets through mixers, and how do I follow digital assets through blockchain bridges, as was the case in some of these hacks. And so at Tokenovate, we've come to the view that UTXO-based systems provide a much greater degree of certainty and a much greater transparency and provenance of where the original asset has come from and where the asset has ended up. And it just, I think, the point you raised and I think the Law Commission raised in their paper was that it's very, very difficult to apply these very kind of strict legal criteria and principles to digital assets as a monolith, I would say. So I think that if we look at the Deloya case, which really centered around the extent to which certain assets within, I think it was Ethereum or perhaps Solana, could be followed or traced or tracked, I do think that the practical outcome of that trial, that the trial centered on some other issues which didn't really get into the fundamentals of the tracing and tracking analysis. But I do think that if you'd kind of gone to the natural conclusion of that exercise, the result may have been different based on whether the coins were stolen or taken from a UTXO-based chain versus an account-based ledger, which, it again perhaps seems like a kind of a technical and a nuanced discussion, good for lawyers to debate at the dinner parties we mentioned at the beginning. But again, I think it does have real and practical consequences. So how do I, as a bank, for example, where I am tokenizing an asset on a chain where I may not have any guarantee as to the provenance of that coin. So has that coin come through a regime that is subject to sanctions? What happens if that of the coin where the security is embedded? What happens if that then goes sort of beyond my control or beyond my reach, and on a chain where it's actually very difficult, if not impossible, for me to recover that? So I think these are questions that lawyers are grappling with, but I think do have real world consequences.
But the inference in Tokenovate view is that the UTXO sort of definition, where the asset is defined through a chain of digital signatures, if you like, providing that digital audit trail, that will maybe provide additional surety when it comes to legal remedy for an asset owner, in case of a legal dispute or a misappropriation, for example.
Yeah, I think that's absolutely right. And so we use the blockchain, I would say, in somewhat of a different, I'd say in a very different way to perhaps some others out there. So we look at the blockchain as providing, we sometimes colloquially refer to it as a truth system. So for us, we use the blockchain as a means of sort of determining provenance of a particular asset or of a particular trade state. So taking a step back, we use the blockchain really for two purposes. One of those is to record what we refer to as a unified trade record. And what that is, it's the, again, going back to CDM and using CDM as an execution or as an operation environment for processing trades. CDM in a way operates much like a state machine in that we have a specific trade object which is generated in the system upon trade execution. And what's happening throughout the life cycle is that things are happening to that trade. It may be business events or life cycle events, all of which have the effect of updating the state of that trade at any given time. So it may be an amendment to the notional, it may be a payment, it may be an ovation, all of that updates the state. And we use the blockchain to record those state updates as and when they occur. So that gives a kind of a golden record, or what we would refer to as mentioned as a unified record of that trade, such that if there's ever a dispute, let's say in 6 months' time, around what the state of the trade was at any given point, we can refer back to the blockchain. And we can prove that based on a kind of what we refer to as a Merkleized or a cryptographically hashed representation of that trade object on chain, that actually matches what the party has recorded in their system. So that is the state of the trade. And we also use the blockchain, as you mentioned, for tokenization. So we use the blockchain really as a means of recording I would say, contractual and beneficial rights to assets that exist in the real world. So people might refer to that as a kind of a digital twin type of architecture or structure. And so what that really means is that, let's say that we have a UK government bond, a gilt, which exists in a CSD. And let's say that people want to tokenize that bond for use within a collateral arrangement. And so what we do is we develop we generate a UTXO, which is linked to that bond, and we create a legal and contractual mechanism which provides that kind of the legal attachment or the legal link. Some papers refer to that as legal stapling between the bond that exists in the real world, albeit in dematerialized form within the CSD system, and the digital object, which represents a party's beneficial entitlement to the bond and the performance of that bond. And we then, provided through that contractual framework that I mentioned and through the UTXO-based system, allow for the transfer of those assets to different parties in our system as orchestrated by the CDM engine. And so that provides, I think, a way of essentially creating a more sophisticated and more atomic set of books and records which record entitlements to these real world assets. And that's something which I think, looking at the Law Commission's paper, and we've done quite a bit of work with Charlie Kerrigan at CMS, who's a real expert in this field, on how we might structure that, and we're very comfortable that that represents a really legally robust way of providing the near-term benefits of tokenization to people in the market without necessarily us yet being in a world where we have sufficient liquidity and natively digital securities such that we could use natively digital tokens for these collateral management purposes. I think we'll get there in the future, but we're in a world today where I think people want to understand the technology without moving wholesale into a more natively digital world. And I think a combination of the way that we use the blockchain, the way that we use these UTXO, this UTXO-based framework, and the way that we structure our legal tokenization framework, I think provides all of that legal certainty and clarity in a way that's, again, entirely consistent with all of the operational standards embedded within CDM.
That's fascinating. Yeah, excellent. So thanks for that feedback. Ciarán, we don't have a lot of time left, so I'm just going to hurry things forward a little bit. But I do want to sort of move up from the change of digital signatures and ones and noughts, just to look at the public policy implications of your work a little bit. I mean, I know Tokenovate had representations in Washington and Brussels. You've been working with regulators, with the Final Conduct Authority, with CFTC in the US. You've been in attendance at New York Climate Week. Just tell our viewers a little bit about how the company is contributing to public policy formation.
Yeah, no, absolutely. It's a really important part of what we do. I think, again, reflecting on how we're using the blockchain, I think we're using it as mentioned, as a provenance layer for proving the provenance of trade records and assets. So we don't view the blockchain and we don't view digital assets as being kind of a tool for speculation and a tool for sort of generating economic performance off the volatility or fluctuations in the value of the kind of the natively digital token. And so when we engage with policymakers, we feel it's really important to make the case that blockchain as a technology can do much more than perhaps people appreciate. And I think a large part of our work is probably shifting the narrative away from this kind of very heavily crypto speculative kind of narrative and more towards looking at blockchain and tokenization as a utility technology. And so we had really good conversations over the past few weeks, in particular with DG FISMA at the European Commission. So Richard and I went to see the Director General a couple of weeks ago, where we were talking about how we're using the technology, as part of a post-trade system for derivatives and for SFTs. And as we got into the discussion, we started talking about existing barriers to cross-border finance within EU capital markets, and reflecting on the work that's happened over the past 20 years within the EU policy framework, things like Target 2, things like CSDR, things like EMIR, MiFID, and how all of those initiatives have really brought a much greater degree of harmonization to capital markets, which in turn have generated a significant amount of growth for member states within the union, but also reflecting on existing barriers that currently exist. Again, reflecting on some of our remarks at the beginning around how we should view capital markets as a tool for driving growth throughout economies. I think there's a big focus within the European Commission and within the Treasury in the UK and within the US around how can we use some of these technologies to generate greater growth. And one of the ways that perhaps we can do that in a European context is to demonstrate how we can use technology to break down some of those residual barriers to cross-border trade and to harmonization across the union. So I think those are discussions that we're really, really interested to have. We think that the technology and in the way that we're using it in particular provides a degree of utility that perhaps current systems and current operational environments don't currently provide, in a way that can actually break down a lot of these barriers. And so we will continue having discussions with policymakers across all of these different regions and explaining to them the benefits of the technology and hopefully being able to demonstrate how the kinds of things that we're doing across the industry will help to generate this growth that I think all economies and all societies at the moment are really striving for.
Ciarán, that's excellent. I'm going to have to start closing things up there because we've, we're low on time, but it's been fascinating. I thank Ciarán McGonagle and Tokenovate for sharing their insights and expertise on this call. It's been most fascinating. I thank our viewers for joining us, and I look forward to joining you all again very soon. So thanks very much to you all, and have an excellent rest of your day.
Thank you.